Now it's time for another insightful panel discussion on the topic fundraising in a difficult macro. Our first panelist is Mr. Ashwin Damera, CEO and co-founder of unicorn edtech startup Emeritus. He is passionate about making quality education accessible to the leaders of tomorrow. He is also a prominent angel investor and advisor to multiple startups. We have Mr. Krishnakumar Natarajan as our second panelist, a leading authority in the global IT sector. Krishnakumar Natarajan co-founded Mindtree. He also co-founded Mela Ventures, which invests in global B2B enterprise SaaS companies from India. Apart from building the startups ecosystem, he has been an active angel investor and has made over 30 investments in a wide range of companies that are technology driven and span across consumer products, healthcare, logistics, financial services. We have Mr. Nitin Bhatia as our third panelist. He is the managing director of DC Advisory with over 16 years of education in technology and software experience. He has led some of the largest fundraising and M&A transactions in the Indian edtech sector. This session will be moderated by Mr. Anand Sudarshan, founder and director of Sylvant Advisor, which provides strategic advisory services in education sector to Indian and global institutions, large enterprises, and investors. Additionally, Sylvant incubates, invests in, and advises startup and early stage companies. May I request the audience to type in their question by clicking on the Q&A icon. They will be answered at the end of this session. Over to you, Mr. Sudarshan, for further deliberations.
Thank you, Dr. Tiwari. Good afternoon, everybody. I'm not sure if Ashwin has joined in because I'm not able to see him. If he is not, then we'll just wait for him to join. We'll get going in the meanwhile.
Yeah.
Good afternoon, KK. Good afternoon, Nitin. Absolute pleasure to be back amidst friends.
Thanks,
thank
Anand.
I thank NIIT, thank Raji Pawar for giving this opportunity. And I'm here this afternoon on a noble quest. This is the quest for learning something new. And I'm looking forward to learning something new from the three of you. And along with me in this journey, all the entrepreneurs, others in the audience, I'm sure will learn as well. The topic that's been given to us is an interesting one, fundraising in a difficult macro. Before we get going, if I can outline the broad structure of the way we do it, we have time till 4:15, I think. No, 4:45, I believe. Nishit, till what time do we have?
Yeah, the program said 4:30 since we'll overrun
4:30. So we'll, yeah, so 4:30.
I presume about 4:40.
4:40, okay. We're just we're running a little late. So we will take time till 4:40. Organizers, I hope that's okay. And what we will do is to make this into a conversation, and we will make sure that we try and address as many questions as come in the chat, in the chat box. But we will also make sure that we have a few minutes right at the end where we try and summarize the key thoughts and the lessons that have come out, so that they remain in our minds as we go out. So let's get this started. I'm going to start with you, Nitin. I want to start with this definition of this topic, fundraising, which of course we understand, but fundraising in a difficult macro. What is this difficult macro that everybody seems to be talking about?
So I think the genesis of this term called difficult macro, as things stand today, has to do with the sort of Fed rate increase program that started, call it about a year back, roughly around that time frame. And to put things in perspective, literally from 0.25%, Fed rate has increased to 5%. And why is that important, right? Let's understand. So, essentially that's the rate at which US government kind of, a treasury operation work. This is the kind of credit worthiness of US government at one level. And subsequently, every single rate that is charged between any two organizations gets driven by this, right? So that's kind of fundamental. From a valuation standpoint, from share price standpoint, I believe, your audience would understand discounted cash flow and kind of, when people look at kind of, the cost of capital and therefore discounted cash flow, etc. One of the key ingredient there is risk-free rate, which kind of, in US dollar terms will be kind of measured by, the Fed rate, And therefore, when there is this, 4.75% to 5% jump, in cost of capital, it does something to kind of, discounted, present value of, cost of capital, right? So, so that's kind of, at one level, what has done. And this is, in my mind, a valuation kind of question. It also brings into play the liquidity question, right? So, when kind of money is in ample supply, free flowing, cost of capital is, close to zero, almost any opportunity looks interesting enough. And so people are, much more free with actually allocating capital, right? Whereas, when there is a cost of capital, let's say if I can park money at 5% with, Fed or at 7% with a bank, then I'll start thinking whether I want to kind of, give it to someone else, right? Which is kind of much more risky in my opinion. So, increase in cost of capital does not only lead to kind of a valuation issue, it also leads to a liquidity issue, right? And if I were to therefore sort of think about, the three things that an investor kind of eventually kind of, very simply put, investor first is, look, do I like this business? Second, is it available at a price that I like? And three, do I have money to pay for this? Right? This change has impacted the question 2 and question 3. Right? So do I like the price? There is a change in notion that has happened, because the cost of capital has kind of changed. And then do I have the money for pay? Maybe in not every situation, especially in kind of VC world, it does not impact things that much. But if I'm a large strategic looking to do an acquisition, I need to see whether kind of, and a lot of acquisitions happen, using credit, right? So if credit is in short supply or kind of the cost of credit has gone up, then my inclination or willingness to kind of transact goes down. Similarly, if I'm a private equity firm, a buyout private equity firm, I typically use leverage to kind of transact. There is, in addition to equity, there's a debt or leverage that I kind of, pile up. And therefore, kind of, that starts getting impacted. So, so those are the kind of, limitations or constraints that people are kind of working with.
And collectively, all of this ends up in creating a difficult environment for investors as a whole.
Anand, I'd just like to add a few more points. I think Nitin very subtly captured the macro environment. I also think with respect to the segments we are talking to, there is what I call difficulty in the sub-macro environment. While the issue of interest costs and cheap money going down is real, there is also a little bit of negativity which has got built around the tech as a segment. Because unfortunately, in the investment world, there is what you call a herd mentality, which happens many times. 2-3 years back, EdTech was the most hot opportunity. So even subpar businesses got invested. But the moment environment gets difficult, and the reason why it's got difficult is that there's a set of negativity prevailing around some of the so-called market leaders, which I think is a little bit also getting overblown. And then there is news about some of the EdTech laying off people, business models not being proven. So particularly in this segment, beyond the macro picture, which Nitin nicely captured, I think there's a sub-macro which is specific to this specific segment.
That's interesting. In fact, that's one of the things I was going to ask you anyway. So let me push that a little further, KK, if that's okay with you.
Yeah.
So here is my thesis. My thesis is like this. When, and Nitin, this is applicable to you as well, because both of you look at life from slightly different points of view. Nitin as a banker, and therefore you see a lot of investors on one side, a lot of prospective investee companies on the other side. And KK, you have a combination of very deep expertise on building markets combined with, of course, your current role as an angel investor and as a VC investor. So my thesis is like this. My thesis says it is a difficult macro, and it's absolutely true that the submicro has some dynamics playing. Tech has got some dynamics playing for it. But the thesis I have is this: when the going is good and there is a frenzy, right? That frenzy leads to non-differentiation. In other words, investors go after herd mentality that you spoke about, go after the same types of companies. So if a lot of people invest, I'm going to take one or two names, no disrespect to any of these companies, but I'm just using those names. If investors go after An Academy and Byju's, other investors who can't get into that kind of a bracket of $50 and $100 million and or more will invest in companies which are like Byju and An Academy. And therefore, in a world like the world of 2021, when a massive amount of money got raised and a lot of companies got funded in EdTech, I'm positing that it is actually more difficult for companies to differentiate themselves and raise money as against today, when that frenetic pace is not there. There is a little bit of a time available for investors to lean back a little bit, be purposeful and consider things. And therefore, the opportunity is actually greater for differentiated companies because people have the time to think through, and look at models that they believe will make sense over a period of time. Does that make sense? KK?
Maybe I'll react a little differently. I think what you make, your thesis, I would agree with, except I think it applies a little differently for what I call two category of investors. One category of investors, even the VC world, is what I would call more the momentum investors who see there's a gold rush and I want to be a part of the gold rush. I think rightly, they would not even participate in this because when the tide turns, they move to the opposite side of the table and then say, you know what, I won't touch EdTech at all. But what I would certainly agree as an outcome of your thesis is that I think there'll be more prudent and serious investors who want to build good businesses. They will look far more deeply, probe into the businesses, and good businesses which have certainly a sustainability and the ability to build value. I think they will get funded by more nuanced investors.
So more nuanced investors. Nitin, let me take that to you and maybe take this to hopefully to a logical kind of a conclusion. In your experience and what you have been observing, and you have been observing this sector, particularly the EdTech sector, you've been actually both participating in the flow as well as observing from the banks. You've had a very unique kind of a position for a long time now. In your view, that's right, 15 years, long time. In your view, just look at the audience now, the ideas, them to be brimming with ideas. Do you see tonally 2023 and beyond to be different and more exciting? And I'm not saying easy, I'm saying more exciting as compared to for entrepreneurs in the tech in the subsector as compared to the earlier years.
So,
and I'm speaking mostly from a fundraising perspective, and fundraising as a milestone, not as an eventuality, but fundraising in the journey. They are fundraising is several rounds of funds as different milestones.
So, I'll say, Anand, that if I'm a EdTech founder, today, there will be no time that I should be actually more bullish than I am today, right? And that may sound contrary to kind of, what one is hearing about the macro and so on and so forth. But I mean, there's a rationale for that. So, see, let's start from the market opportunity, right? India has 250 million school-going kids. India has 9 million graduates every year and so on and so forth, right? It has always been a very large student market in education, right? Number one. Second, we have always been very poor in terms of quality of learning, right? So if you will look at sort of, various studies that have happened. You look at kind of, reading and math proficiency level for, grade 5 students, there is a report that gets published. There's another report that says 11% employability out of all kind of college grads and so on and so forth. So, fundamentally, India has been a market which has been very large historically, and at the same time, very poor in terms of quality of learning, right? Those realities remain unchanged, right? It's not like, in the last 5 years or 10 years, that reality that it's a large market with an unsolved problem, right? If I think about it, it continues to be a large market with an unsolved problem, right? The third thing, which is actually in some way good news, that has happened, is there were certain attempts that were made to solve these problems in certain form and shape. And you mentioned a couple of names there. After 5-6 years of that experimentation, in some way this current round kicked in with kind of the Byju's investment in 2016, which kind of really kind of accelerated this whole edtech movement at that point in time. It is fair to conclude that there is still a lot to be done, right? And again, without kind of commenting on what someone has done well or not done well, physics wala has done well, somebody else has maybe not done well, etc. Reality is that after 5-6 years of this first level attempts, right, you have still come to a conclusion that much of this continues to remain unsolved. And therefore, anyone who has good ideas of how to solve this at scale has a pretty good shot at doing it, right? And again, since, I was listening to Alak in the previous, this thing. Now, somebody like a physics wala came in pretty late. They reinterpreted, the market, said, look, the market is not for, 1 lakh students or 2 lakh students who have to pay 1 lakh rupee every year or 2 lakh rupee every year. There's a different way to use technology to attack this market. And you created an innovative offering and they have kind of taken off. So my simple belief is it's a large market, it's an unsolved problem. There's a particular way in which people try to tackle it. Some of it worked, some of it didn't work. End result is, the field is still wide open for new companies to emerge with new ideas, new thinking of how to kind of, attack these problems. And there will be fresh capital available. I mean, look, there is record dry powder. Everyone talks about it. Now with, China in some way kind of taking a back seat in the minds of, the VCP community, more capital will flow. So, it's not like supply of capital is a constraint, right? I think the constraint is, demand coming from quality companies, quality businesses, quality ideas. So I there is no reason for us to be pessimistic. And this is kind of, my kind of message to your audience is there is just no reason for us to be pessimistic about, edtech at this stage. Actually, there's a clear window or door that has opened up for new ideas to emerge and new disruptive businesses to kind of, scale and nurture.
No need to be pessimistic. Ideas will get funded because there is liquidity available, and India will be a destination of choice. And you have to distinguish yourself and differentiate yourself and provide or show that value exists. I'm going to take that to, but KK, but before I go there, I want to address one topical matter and kind of get that out of the way. Silicon Valley Bank, it's there in the papers. Everybody has read about it. And I want to, to ask you this question. In your view, the Silicon Valley Bank going bust, and by the way, it's not as much of a bust as it's been made out to be from whatever I can read.
Correct.
It's almost like somebody had written, the CEO and the executive team seem to have been like Boy Scouts rather than anything else, because the maths, when I was reading, didn't seem to make any sense to me. They didn't need to go down, but I don't understand it that well. But it's on the face of it at least. But that kind of a bust of a Silicon Valley Bank, which is really the bank that was deeply embedded into the startup system, at least in the US and many of the Western countries, does it affect the macro? And look at it, the sub-macro and sub-macro from two different points of view. A tech sector, India, from that perspective, does it affect at all?
See, my view on that is, while it would create some short-term liquidity issues, particularly for startups which have large operations in India and are domiciled in US. And if they've raised capital in US, they obviously would have put in some money into SVB. So it might create some short-term cash flow issues for them. And now with the government very intervening in a positive manner, whatever I heard from some of these startups is that they were able to access even that quantum of money on Monday, though they said Monday morning, I believe during the day they were able to access that capital. So I do not see that creating any impact in terms of either the Indian startup ecosystem or Indian startups which are really trying to access US as a market.
That to be a problem at all.
Yeah.
That's really good to hear. I think it's important for people to understand. There are some issues maybe for some people in the US ecosystem, but I think as entrepreneurs in the ecosystem and for investors looking at the Indian ecosystem, this may be a little blip maybe for some of them, but really speaking, not a big deal. I was just listening to the Nazara CEO on TV, who's one of the guys who got some money stuck there. I don't remember the amount, I think 75 crores or something like that, which is stuck there. And even he was pretty clear that he really wasn't that much worried. And the FTIC news item that was news release that was published very clearly says all of the money would be accessible, which is a big relief. It's not a fraction or whatever. So let me push on from there to the next level. So we have established this. We have established A, that you need to be a differentiated company. B, don't worry, opportunities abound. C, the India story, I think Nitin was at pains to point this out. The India story is a big story. This is a big market. It's a complex market. It's a market where lots of solutions are waiting to be discovered and delivered, and value is waiting to be created.
Right.
And therefore, opportunities abound. There is absolutely no need for us to, worry ourselves about complicated macros, okay? Difficult macros and stuff like that. So with your permission, I'm going to change the topic, okay, of this session for the rest of the session. So I'm not going to talk about fundraising in a difficult macro. I'm just going to say fundraising. Okay, so we established, right, the difficult macro, maybe a little blip here and there, but it's not really a difficult macro. So let me just come back to fundraising per se for startups. I think, in your opinion, in your view, KK, I'll start with you first, which is what is it that startups need to do to focus on from a fundraising perspective as an investor sitting on the other side? I know you look at certain sectors, but if you wear the hat of all investors, VC investors particularly, what is it that you would be expecting startups sitting in front of you presenting their case to speak to you about? What is it that you will be looking for?
So the first thing is a very clear articulation of what is the problem they are solving. And my second question is it the problem really to be solved, or it's not one of the top priority problems? And that's true across all segments, be it at tech or be it B2B SaaS. I think the problem being solved should be a problem which needs to be addressed. The second key thing, of course, in any early stage investment, one looks at the team. How is it that they are gelling together? How are they going to really stay together? Because any business will go through significant ups and downs. And are they capable enough of solving difficult problems without sort of giving up? But the third aspect is really, how are they really getting to the market? Because particularly in a segment like a tech, acquiring your customers at a reasonable cost really sort of paves the way for you to build a sustainable business. So how are they planning to do that? These are probably three top of the mind points which I would really look for.
So you talked about how well do they understand? Yeah, how do they solve the problem and how clear are they about the problem? The third was CAC. What was the second?
The second was the team. In fact, how
okay.
do they bring
Yeah,
complementary
obviously,
skills? How are they gelling together?
So the tangoing, Ashwin,
Yes.
hello. Good to see you here.
Thank you. I apologize for joining a little late.
No worries at all. Ashwin, just to bring you to speed very quickly, we've been talking about what is this difficult macro all about, and how does it affect? We very briefly spoke about SVB and the impact that it could have, the bust of SVB and the impact it could have. And this is what we have come to as a conclusion. Number one, in as far as India is concerned, in as far as the submicro, which is the edtech sector, is concerned, we are very clear, at least between the three of us, we are very clear that the market is alive and well. There are a number of opportunities. It's a huge market, large number of opportunities that exist here. And there is really no need to complicate oneself by thinking about difficult macro and stuff like that. And if that's the case, we said that we'll change the session topic just a little bit. Instead of saying fundraising in a difficult macro, we just drop off the difficult macro and say, just focus our attention on what is it that entrepreneurs need to do to fundraise. I'll stop there, and I'll request you to just add your thoughts based on whatever we've said. Just if you can just add your thoughts and kind of get into the stream.
Thank you, Anand. So look, maybe a quick few points, right? Based on what I have heard from investors over the last, say, 6 months. One is, I'm not so sure the SVB issue is a big issue, but there are other issues, which is primarily two things. One, I would say, I want to break this up into two stages of companies, right? One is early stage and then late stage. In the late stage companies, so think of these as companies above $1 billion valuation, that is actually a tough space to raise capital. And there are many reasons for that. If I would just quickly summarize and say, look, there were many crossover funds, hedge funds who are investing in these companies. They also have public market exposure. Public markets have fallen 40 to 50%. And so they have to balance their portfolio. So they've stopped investing in private markets, also public markets, which have liquidity of far more attractive valuations. So if you are a late stage company, so Sunicorn, Unicorn, that kind, the market is really difficult to raise capital. But if you look at early stage, I'm not sure, especially for Indian companies, given the TAM and the addressable opportunities, I don't think there's a funding winter at all. Maybe more questions are being asked, but check size of $5 to $20 million. That's a very different type of a capital. That's a Sequoia, Axel, Lightspeed. They're growth investors. They don't have public market exposure. They are still writing checks. There are still deals to be done. So I think that's kind of one lens at which we can look at this funding winter. A lot of the noise around this is happening around late stage ventures. The second thing that I would also maybe just add is a lot of deals we're starting to see now are structured deals, whether it's a guaranteed IRR, whether it's a higher lick pref, whether it's a discount to the next round, or instruments that have some coupon plus some warrants and those kind of deals. A lot of innovative deals. And the question that is asked is why? And the reason is that despite whatever is happening in the macro environment around us, the truth is that there is still a lot of capital that needs to be deployed. Funds have raised in the last 1 or 2 years, record amount of capital. And so they have to still deploy. So there is still money chasing good deals. It's tougher for late stage companies. That's why you see a lot of the structuring. But for early stage growth companies, I think you're actually seeing deals still happen. And so depending on which stage of the spectrum you are as an entrepreneur, it's either a little gloomy or it's pretty bright.
Thanks, Ashwin. Just a quick follow-on. It's great points that you make. A quick point is this: think about structured deals, and I'm going to touch upon that a little later, but I want a clarification right now. The structured deals is a standard, playbook entry for PEs. For not now, it's been there forever. Any PE making an investment, in all probability, will come with some kind of a structuring or of some kind, which will be part of the deal. It's nothing new, really. Are you saying this structuring piece is now moved into the sub $20 million early stage raises as well?
So Anand, look, the PE guys, if you look at, say, the large ones, Carlyle, KKR, General Atlantic, Warburg, a lot of them, yes, this is, like you have correctly said, this is bread and butter for them. But if you look at the investments, if you look at a year or two back, if they try to do those kind of deals for tech companies or consumer internet companies, they would not accept it. Like I've had this conversation 2 years back where there was a P who said, I'll structure something for you. And I got a straight out equity deal at a valuation that we were comfortable with. And we took a straight out equity deal, right? However, in today's market, if there's no straight out equity deal, then you're much more open as a late stage company to look at these structured options. So I think you'll start seeing structured options in consumer tech, internet, high growth companies coming from these PE guys. However, like you rightly point out, it's more for late stage companies. For early stage companies, anyways, if you're looking at 15, 20 million, that's not where the PE guys play. That's still where the growth equity players are. And look, they anyway underwrite risk far more than a PE investor is willing to take, right? So I don't think we're seeing that much structure. In fact, if I could ever give advice to an entrepreneur, early stage, better you don't take structure. Take out straight deals, the valuation is lower, just sleep better at night and build for a much larger outcome. So it's really more in the late stage that we're seeing this.
No, fair enough. So let me just come back to the thread of our conversations earlier. Nitin, I'm going to continue that I'm going to summarize for Ashwin, and then I'm going to continue asking the question to you, and then I'll come to Ashwin after that. The question that I was asking, KK, was that if therefore fundraising is the key point, and some of what you said is also, Ashwin, what you said also is pretty much pointing out to that, that, there is, markets to be conquered, there is value to be built, and there is money, there to support. So, Nitin, what KK said is three things. What's required is one, do you have a clear thought process, and do you have a solution that's got value in the marketplace? Second is, do you have a team that is gelling with each other, that's complementary in terms of skills and capabilities, and it's working well visibly? I suppose you didn't say that. I'm adding that an investor always looks for visible physics, chemistry, whatever you want to call it, between team members at some stage or the other. I suppose KK talked about that as well. And the third part, what he talked about, is the acquisition cost, consumer acquisition cost, CACs. Are they reasonable, handleable? How do they play with profitability, eventual profitability, and so on and so forth? All of that kind of together. What is your view? Are these the things that that entrepreneurs need to focus on, or are there more, or is there any other nuance of these three that you would like to highlight?
So I'll say some of these have always been there. So in fact, all three things that, KK mentioned have always been there. The nuance I'll say on two of those, see, what people have realized is that for a lot of these businesses, KK mentioned product market fit, right? People are having today a more nuanced and better understanding of what does the customer actually want, right? As an example, we had Alak, from Physics Wala in the previous conversation, and sort of, so there's, you can put a Physics Wala and a Vedantu model side by side, and you can start debating, what works, better in what context, right? So depending on customer segment, one solution may work better than kind of, something else, right? The second point is, and we saw this as we came out of, let's say, the COVID, related issue. During COVID, if you are an edtech company, you were essentially kind of competing with only other edtech companies, right? But once you kind of moved out, you are now competing also with other offline companies who have, compelling solutions. They have been successful and have been around for a while, etc., right? And therefore, the question is, when I'm going to compete with offline and online players, what is my product market fit, right? And, we have seen investors now having, let's say, a deeper understanding, a more nuanced view of what qualifies for a great product market fit, right? So that's a nuance in some way. The second piece is, and again, I'll take KK's point on kind of CAC and kind of, unit economics and so on and so forth. But I'll say that, again, it's kind of a little bit more, whole, in the sense that, and we call this as customer development in kind of, the parlance, which is, look, how I'm going to take this unit of scale and I'll scale it to like, 1 million, 10 million, 100 million, and so on and so forth, right? And, one part of it is whether the CAC works or not today. But, the other is that, the path to getting to 1 million users is different, from the path to getting to 10 million users, and it will be different to the path to getting to 100 million users, right? And therefore, do you have kind of, a more nuanced understanding of how you will continue to scale, right? So I'll say, 3 years back or 5 years back, you just had smaller edtech businesses, right, that were dealing with smaller set of numbers. You are today dealing with much larger set of numbers, and therefore, you have to revisit some of these questions. So if you are at 10 million users and your next target is 50 million users, you will have to think differently about customer development versus when you were 100,000 users and you had to kind of get to 1 million users. I'm just saying,
Okay.
these are different category of problems in some way that you have to think about.
Okay.
But I'll add two more things to what KK mentioned, which are new, right? One is the fact that the patience with respect to when investors were okay to see, let's say, a break-even point or a profitability point has shifted. So it is not enough for you to just say, I have product market fit, I have a solid customer development model, I have a great team, because if the way someone described it is, if earlier investors were okay having a telescope to profitability, now they want a binocular visibility to a profitability, right? Like, a telescope visibility to a profitability no longer works. You need a binocular, visibility to profitability, right? And kind of translated, when we are kind of, doing our work, we are advising companies that you need to demonstrate how you're going to get to profitability in next 18 to 24 months. Anyone who is kind of not guiding for, and we work generally with Series C, Series D and higher companies. So, that may be different for, a Series A, Series B company. You may have more, room to cover in terms of, path to profitability. But if you're a growth equity or a late stage growth equity company, right? And if you're guiding for more than an 18 to 24 month timeline to kind of profitability, that's a big problem. Right? And we just need to kind of be mindful of, and Anand, in pre-conversation, you were talking about narrative. So I believe, path to profitability, how you will get there with reasonable, assumptions and, demonstrating evidence is part of the narrative, right? It's not something which is an afterthought, it is a part of the narrative. The other thing that I'll say is that, the exit assumptions have changed. And what I mean by that is, 2021 and 2022 deals that were happening, it was okay to say, I'm going to price myself as price to sales multiple of X, right? And, that is good enough because other companies, that are my peer group are also kind of getting done as a price to sales multiple, for example, right? Today, and I was listening to, Rohit, who is the CIO of Temasek, give a chat, and that's kind of consistent with what, a lot of other senior PE folks are saying. If you're an IC member in one of these PE firms, you are saying, guys, I'm going to get valued at exit on a price earnings multiple or an EV/EBITDA multiple, right? So I need to work backwards from, on a steady state basis, what kind of margin I have, what kind of profitability I have, etc. And I need to work backwards on what's the valuation I can pay today. So a pure, let's say, a comparison with peer group in terms of price to sales may not be the best way to present your narrative, right? You need to kind of change your narrative to, again, kind of incorporate the fact that in a steady state, this is the kind of profitability that this business can have. This is the kind of long range, valuation multiple that businesses like these can sustain for these reasons. Fair. And therefore, there's a fair valuation. Again, fair. The second thing is generally not pertinent. It is pertinent in this market because a lot of investors, and, this is, to the point that Ashwin is saying, the reason why structured deals are happening is because there is a disconnect between how companies think about valuation currently and how investors are thinking about valuation currently. And so you're finding a structure to kind of bridge that gap. But fundamentally, therefore, in the long term, right, if you have to return to a straight equity model, for example, you will have to translate your business journey into a language that customer an investor can understand, and that will involve kind of talking about steady state, margin, steady state profitability, and how soon you can get there, in a much more.
Fair enough. Fair enough. Thank you, Ashwin. I'm just going to take it from there. I'm going to add one unrelated question to it because it's of, again, topical interest. Very quick answers because we're kind of running out of time. We have over 8 minutes more. Don't think we'll be able to take any questions from the audience today, but I'd like to take this and leave. So we've got 5 thoughts that have come up now, right? You've heard both KK and Nitin express 5, thoughts. Which includes the solution side of it, which includes the team, which includes the cost of acquisition, which includes the path to possible, the visibility path to profitability, not telescope, it's more binocular, so long as it's not short-sighted. I think the rest of it is all okay. And the narrative, there's a broader narrative to the scaling part that Nitin talked about. Very, very quick this thing from you. And because I cannot have any EdTech conversation these days without touching upon generative AI, very quick, I would like you to add, how do you view generative AI impacting EdTech businesses? Just for it. First, comment on these 5 points that I've made, add to it, nuance it for a couple of minutes, and then maybe a minute on generative AI before we sum up.
I mean, great point. And I like the way in which you summarize these 5 things. But, sometimes 5 things is also too much for an entrepreneur to think about. So let's just make it one thing, right? And if there's any advice you can give an entrepreneur, I think Nitin mentioned this beautifully, which is profitability. And by the way, even if you think about binoculars, I think that he's being a little charitable, saying you have 12 to 18 months. I think investors want to see profitability right now. And then only you're going to be really investable, and at least you'll get a valuation that's even close to what maybe the entrepreneur wants. Because in many sense, right, all the stuff around customer, product, market fit, all of that is captured if you have profitable growth, right? So earlier it used to be you have to grow 80%, 100% year on year to be a good company. It doesn't matter how much money you lose. Today people are saying, look, you grow 20% also, it's fine, be profitable. And so the rule of 40, right, is your growth plus EBITDA, as long as that's 40% or more, I think has come back. So if I were to just simplify it, clear path to profitability, if not profitability, even at a lower growth, is really what I think the EdTech entrepreneurs need to think about. And if you think about it, look, EdTech as a business, if you look at the entire consumer tech landscape, if there's one business that can actually be profitable and grow, it should be EdTech. If you really think about it, there are many characteristics, of all of us, who have run EdTech businesses or education business. If you really think about it, right, you connect your money from your students upfront, you may pay your faculty and partners over a period of time. So why would you not be profitable? And I think in the next 12 months, you're going to see many companies pivot to that profitability, including, ourselves. On the generative AI piece, look, in a moment where you're thinking about path to profitability, generative AI may be a luxury to think about. That's one thought. But the other way to think about it is it's here, it's now, right? And we are having conversations in our company today itself, which is, and by the way, it's linked to profitability also in a certain sense. It's also linked to customer delight in a different sense, right? But if I had to take some of our grading and stuff, there's a lot of grading. If you grade, say, 1,000 assignments, 800 of them could have been done well by something like a chat GPT because they follow a certain pattern. You have a solid rubric, you can figure that out. Maybe that 20% requires some manual intervention. In terms of a tech business that's looking to scale, there's a massive cost advantage. There's also a customer delight. You can grade assignments like literally very fast versus manually, et cetera, right? But I also would caution that we're in very early stages of figuring this out. There are going to be a lot of use cases, but we're still very, very early, and actual adoption is still very nascent.
Fair enough. Thank you very much. That's all we have time for, actually. We've been asked to speed up, and the next session is already getting delayed. So here is my takeaway from this very interesting conversation. If you had to walk back as an entrepreneur, I would walk back with the following things. Number one, don't get hassled by all these difficult macro business, right? The Indian story, the EdTech sub-story, as what KK pointed out. The opportunities that are there in India, they are real. Money that's available to be invested, particularly for early stage companies, is very much there, and it's real. It's like Nitin pointed out, fact of the matter is, there aren't too many other options in really growth markets except India. Therefore, people will look at India, are looking at India very aggressively. So do not worry about that. But for you to be able to succeed and raise money, if you were to focus on it, think of this as a visual, I think visually. So this is a visual metaphor for you to remember. Think of an arrow. Okay, the feathers of the arrow will include what is the solution that you're offering, and what is the kind of team that you have put together, right? Very strong focus on unit economics, cost of acquisition, and so on and so forth. And of course, what are your strategies, thought processes, capabilities? What is your willingness to add on to capabilities as you start scaling and imagining scaling as you go forward? And some of it will be a kind of a step function. And sometimes it might be depending on your nature of your solution and the market that you're playing in, the curve may be a little different. But the tip of the arrow is profitability and profitable growth, as what Ashwin. So think of that as possibly a single visual metaphor that you can keep and take away from here. Just I want to add the last point that Ashwin made about generative AI, because that must be a curious question that must be there in everybody's mind. And like he rightly pointed out, we still are yet to find out what exactly generative AI is going to do. It is clear, absolutely clear. I'm talking EdTech and education here specifically. Generative AI is there to impact education sector, EdTech sector in a big, big, big way. No questions about it. I, for one, think, and this is not the forum for a conversation, and I'm very happy to do another conversation on this. I for one, happen to think that generative AI is actually throwing up a massive amount of opportunities, two kinds of opportunities, new opportunities for entrepreneurs such as yourselves to build your stories around, and an opportunity for differentiation for existing companies, unicorns, companies such as Ashwin's, others who are building to unicorns, and unicorns are building to become larger organizations. It gives them a great opportunity to differentiate themselves, because this is where they can introduce incremental value, which can itself grow into a new branch and a new set of values per se, I believe. So that's a very interesting part. On that point, I'd like to thank all the panelists. Thank you very much for your insights. I hope it was of use to all of you, audience.
Yes.
And I hope you all enjoyed it. Thank you very much. Thanks to NIT for putting it all together. Back to you, Nishit.